I really did not want to make this video. I know how it sounds. Another person on the internet predicting a crash. Another doom and gloom creator trying to get views with fear. But I cannot stay silent about what I am seeing. The data is too clear. The patterns are too obvious. The risks are too severe. Something massive is coming in 2026. And most people are completely unprepared. Their retirement accounts are fully exposed. Their emergency funds are empty. Their jobs are more vulnerable. I am going to show you exactly what is coming and, more importantly, exactly how to protect yourself and your family. This might be the most important video you watch this year. Before we dive in, let me be clear about something important. I am not a fear-monger. I do not believe in hiding under your bed waiting for the world to end ever. I believe in being strategic. I believe in understanding reality so you can position yourself to thrive no matter what. The people who built generational wealth during past crashes were not lucky. They were prepared. They saw what others missed. If you are serious about protecting your financial future, subscribe right now and hit that like button for this information. Let me walk you through exactly what is happening in the American economy right now in 2026 and why. The first major indicator is the state of consumer debt in America. Total household debt has surpassed $17.5 trillion. Credit card balances alone have exploded past $1.2 trillion, with average interest rates exceeding 22%. Americans are putting groceries on credit cards. They are financing basic necessities because their paychecks no longer stretch far enough. Credit card delinquencies have risen to levels not seen since 2011. This is not a sign of a healthy economy whatsoever. This is a sign of an economy being held together by borrowed money that is running out very quickly now. The second indicator is the state of the American consumer. Exposed savings built up during the pandemic have been completely depleted. 60% of Americans report living paycheck to paycheck, including many households earning over $100,000 annually. When the consumer is stretched this thin, any economic shock can trigger a cascade of problems that feed themselves rapidly. Job losses lead to missed payments. Missed payments lead to defaults. Defaults lead to bank losses, then credit tightening, then more layoffs. The third indicator is what is happening in the commercial real estate market. Office buildings across America are sitting half empty. Remote work has permanently changed how companies operate. Commercial real estate values have dropped 30 to 50% in many markets. Banks are sitting on hundreds of billions of dollars in commercial real estate loans that are coming due for refinancing now. Many building owners cannot afford to refinance. They cannot sell because there are no buyers. They are completely trapped now. Regional banks especially are exposed to this ticking time bomb. We already saw banks fail in 2023 from similar pressures. The fourth indicator is the inverted yield curve situation we have been experiencing. For those unfamiliar, let me explain this quickly. An inverted yield curve is when short-term bonds pay higher interest rates than long-term bonds. This is historically very abnormal. Historically, it has preceded every major recession in the past 60 years. The yield curve inverted in 2022 for a record time. Historically, the recession arrives 12 to 24 months after the inversion begins. We are now deep into that warning window. The signal has been flashing for years now. Most people have simply stopped paying attention to it, but the pattern remains clear. The fifth indicator is corporate earnings and layoffs. Despite what stock prices might suggest, corporate America is really struggling now. Major companies across technology, retail, media, and finance have announced massive layoffs affecting tens of thousands of workers nationwide. Companies do not lay off tens of thousands of workers when business is booming. They do it when they see real trouble ahead. The labor market that appeared so strong is showing cracks. Job openings are declining. Hiring freezes are spreading across industries rapidly. The unemployment rate has started ticking upward. These are early warning signs that historically precede larger employment contractions coming soon. The sixth indicator is government debt and the federal deficit. The national debt has surpassed $36 trillion as of now. Annual interest payments on this debt now exceed $1 trillion per year. That is more than the entire defense budget spent on interest. The government has limited flexibility to respond to a crisis when it is already running massive deficits every single year now. During the 2008 crisis and the 2020 pandemic, the government could inject trillions into the economy for stimulus. That option becomes more constrained and more inflationary with each passing year of deficit spending that continues to accumulate now. The seventh indicator is the state of the stock market itself. Valuations by many measures remain elevated despite economic warning signs. The market has become increasingly concentrated, with a small number of massive technology companies driving most of the gains now. When markets are this top-heavy, a decline in just a few stocks can drag down entire portfolios and retirement accounts significantly. Meanwhile, retail investors have piled into the market in recent years, many of whom have never experienced a true bear market before. They do not know how they will react when their portfolios drop 30 or 40 or 50%. History suggests many will panic sell.
Now, I want to be very clear about something. I am not telling you I know exactly when the crash will happen for certain. Nobody knows exact timing. Anyone who claims to know precisely when markets will crash is lying to you right now.
What I am telling you is that the conditions for a major correction are present right now. The kindling is stacked very high. The matches are everywhere around us now. Whether it ignites next month or next year, the risk is elevated and preparation essential. Let me tell you what happens to unprepared people during market crashes, because understanding this will truly motivate you to take action. Their retirement accounts get devastated. Years of savings and compound growth evaporated in months. People close to retirement have to delay their plans by 5 or 10 years. Their jobs become vulnerable. Companies cut costs during recessions, and payroll is always the largest cost that gets reduced first. Layoffs spread across industries rapidly. Finding new employment becomes extremely difficult when everyone is cutting at the same time now. Their homes become traps. If you bought at peak prices with minimal down payment, you quickly end up underwater, owing more than value. If you lose your job, you cannot make the payments. Foreclosure devastates your credit and your family for years to come afterward.
Their emergency funds prove inadequate. Most Americans have less than $1,000 saved for emergencies, which disappears immediately in crisis.
They turn to credit cards desperately. Then they max out the credit cards completely. Then they have absolutely no options left at all. Their marriages and relationships suffer terribly. Financial stress is one of the leading causes of divorce in American families today. The pressure of job loss and mounting debt and watching your net worth collapse tears families apart completely. This is documented history. This is not fear-mongering at all. This is what happened in 2008 to millions of American families. This happens every single crash. But here is the other side of that history that people forget. Every single crash also created massive opportunities for those prepared. The people who had cash during 2008 bought real estate at 50 cents on the dollar and built tremendous generational wealth. The people who kept investing during 2000 accumulated shares at generational low prices that multiplied many times over since then. The people who had stable income and emergency funds used the crisis to leapfrog financially, while others fell behind them permanently. This is why preparation matters so much right now. You are not just protecting yourself from downside, you are positioning for lifetime opportunity. So let me tell you exactly how to protect yourself and your family from what may be coming soon. Here is Step 1. The first and most critical step is building a substantial emergency fund immediately. I am not talking about 3 months of expenses here. In this environment, you want 6 months minimum, 12 months if you can manage it. This cash needs to be liquid and accessible. High-yield savings accounts are perfect for this purpose. You want this money earning 4 to 5% while sitting safely available. This emergency fund serves multiple purposes that most people overlook. It covers your expenses if you lose the job unexpectedly. It prevents you from being forced to sell investments at the worst possible time when markets are down and prices are lowest. It gives you psychological stability to make good decisions when everyone else is panicking around you and making emotional choices badly. It positions you to take advantage of opportunities when assets go on sale during the crisis at deeply discounted prices available. The second step is reducing your debt burden aggressively starting right now. High-interest debt is a financial emergency during good times. During a recession, high-interest debt becomes potentially catastrophic. Credit card debt at 22% interest will bury you completely. Pay it off now while you still have income flowing. The lower your fixed monthly obligations, the more resilient you become. Someone with $2,000 in monthly debt payments is far more vulnerable than someone with $500 in obligations. The third step is stress testing your income honestly. Ask yourself how secure your job really is if cuts were announced tomorrow. What would happen to your position if your company needed to cut 20% of staff today? Would you survive those cuts? Start building backup income streams now while you can. Side businesses and freelance skills and consulting capabilities provide real security. Additionally, focus on making yourself indispensable at your current job. Take on important projects and solve visible problems consistently. The fourth step is reviewing your investment allocation carefully. This does not mean selling everything and going to cash completely, though. Timing markets is nearly impossible, and you will likely miss significant gains trying to do so. But understand what you actually own. Ensure your allocation matches your risk tolerance and time horizon. If losing 40% would cause panic selling, you have too much risk. Consider maintaining a larger than normal cash position within your portfolio. Cash provides the ability to buy aggressively when others sell. The fifth step is avoiding major financial commitments until the picture becomes clearer. Now is not the time to stretch for expensive things. Every major financial commitment reduces your flexibility. Stay lean right now. Keep all of your options open for now. The sixth step is preparing psychologically for volatility ahead. If a crash comes, your portfolio will drop. Your home value will drop. Your job is to remain calm and stick to your plan. Historically, the worst thing is selling in panic at the bottom. Those who sold during March 2020 missed one of the fastest recoveries in history. The seventh step is looking for opportunities that emerge during downturns. While everyone else panics, smart money is positioning for gains. Real estate prices drop and motivated sellers appear. Stock valuations become attractive. Business assets become available at deep discounts everywhere. Now let me give you important perspective. I am not predicting the end of the world here. Markets have always recovered historically. What I am telling you is that preparation has no downside whatsoever. If the crash comes, you are protected and positioned for opportunity. If no crash comes, you're still prepared. It's a win-win. If the crash does not come, you still have your emergency fund, eliminated debt, and built income streams. None of these hurt you. Take action this week, not next month. Calculate your emergency fund needs and start building towards 6 to 12 months of expenses. First, list all your debts. Next, create an aggressive payoff plan. Now, evaluate your job security honestly. Finally, begin developing backup income now. Take action on these steps today. If this video opened your eyes, subscribe right now, because I share content to help you build wealth and navigate any economic environment. A once-in-a-lifetime crash may be coming, but it can be opportunity, not disaster. Protect yourself and position yourself. See you next video.